I spoke with the founder and CEO of DoubleLine Capital, Jeffrey Gundlach, on his investing priorities this year, the outlook for the Federal Reserve's path to an interest rate cut. Watch.
I feel there's a little bit greater chance of 2 rate cuts now because economic data has gotten very soft in the past month. It's weird how the economy changes. You know, at year end in December, the betting was 7 rate cuts were priced into the market, which just seemed absurd.
It did.
You know, I mean, it's just, you have to cut all the time. And then that reversed a lot. The price of oil going up had a lot to do with it. And the price of oil going up in energy led to higher CPI readings than were expected. If you look at the components of the inflation rate, you've got what's really driving things has been auto insurance and shelter, things like this. In the most recent reading, used cars were negative by a significant amount on a year-over-year basis. But the thing is, not all these things are really comparable. Like used cars, what percentage of the population does used cars pertain to? Mm-hmm. I know it pertains to big rental car companies that buy and then sell them out, but what percentage of the population is affected by used car inflation on a personal level? I don't know, single digits?
Right.
Well, what about auto insurance? Well, you're forced to buy auto insurance, and you have to renew it every 6 months.
That's good. That's going to affect a lot of people.
And that's running up at about 20% year over year and 6 months annualized. What about homeowners insurance? Homeowners insurance is way up too. Now, you don't have to have by law homeowners insurance, but most people, for peace of mind, you know, they don't want a catastrophe in their life. Homeowners insurance, all of these things are up tremendously, the things you have to buy.
Well, these are the essentials. I mean, food, fuel, and shelter. And I'm wondering why we haven't seen a bigger impact from the 11 rate hikes, because people keep saying, oh, the economy is fine, and yet then we see everyone using, you know, buy now, pay later. They're tapping into their credit cards. We've seen 3 straight months of hot inflation. Do you think that maybe it takes more of a lag than we even thought? Because
this time, yes.
You were expecting a recession.
I think it was very difficult to map over prior cycles to the last couple of years because of it's not so much the monetary policy, which was quite restrictive, all those hikes, the fiscal policy.
Big important
fiscal
point.
Policy from 2020, 2021, 2022, the M2 prior to the lockdowns and so forth was growing like this. It's a very steady pace. And then all of a sudden, here come the trillions.
Do you think we still will see a recession?
Of course.
Yeah.
Of course.
This year?
Hard to say.
This year or next year?
Sure. I think the data that's come out is quite concerning over the past week. I mean, a month. A month ago, if you subdivide the economy into 6 or 7 major sectors, all of them were experiencing positive growth. All of a sudden, in those same numbers this year, more are negative than positive, and the positive ones are less positive. So, yes, I think that the lifestyle adjustment that was allowed by all of that money printing got people to a lifestyle that they decided that they weren't getting checks for the government, but they were willing to put it on a credit card. Mm-hmm. And those credit card bills are really starting to add up.
No, I think we're spending $1 trillion every 10 days, or borrowing $1 trillion every 100 days. I mean,
$1 trillion every 100 days.
How is that possible? And why aren't markets focused on the debt and deficits? You talk about it.
They're starting to get focused on them, and I think that higher for longer is going to lead to a recession, because what really higher for longer is about is you're not going to take out, you're not going to take out Tesla necessarily. They might have other problems, but it's not going to be because of interest rates. What you take out is the people, small business, medium businesses that used to borrow at 4% on a 90-day revolver. Those have rolled over 11 times to higher rates. So they're now not at 4, they're now up at around 10% is what they're borrowing at. And every time, every month, every quarter that you're paying that sort of a rate, it eats into the cash position, and you're going to take out some of these companies. 2
questions about the election. This is an election year, obviously, and I wonder how that plays into your thinking, because on the one hand, I think Treasury Secretary Janet Yellen is setting these auctions up in a way that keeps rates low and stocks high going into the election. On the other hand, we're seeing the polls out there. Are markets starting to get more comfortable with the potential change in policy after November? Would that be good in terms of a change in policy? Less spending, perhaps change in China policy. You've got a lot of policy I want to talk to you about.
I'm not sure that there's a record that would say that Trump coming back to the White House would reduce spending. He was kind of on the same path, although he didn't do, probably wouldn't have done the absurd 2022 money printing. That really is, the 2021, 2022 is really what sort of killed everything. But I think it would put together something. He would have policy. See, and
less regulation.
Yes, less regulation, and certainly more energy production. Mm-hmm. I think that's right. But the problem with the current administration, in my opinion, is that there really isn't a policy North Star. It seems to be that the opinions change and the policies change depending upon whether an issue polls at 55% or 45%. And I think people are realizing this. This back and forth on the energy policy, the back and forth on the Mideast policy, the claim that the border is secure and now it's not secure, all these things, I think people don't like being gaslit. Mm-hmm. And I think the reason that the popularity, the favorability ratings of the current administration, the vice president and the president, are 40 or lower is because people don't like the fact that it's vacillating. It's not a policy, it's a vacillation based upon how well something's polling. I know that all politicians do that, but this is pretty blatant.
We keep seeing this as a result, and that's why the polls are moving the way they are, because we keep seeing everything's about the polls. Where is your North Star? Let's talk Israel policy for a moment, because for weeks this administration was telling us we have an ironclad support for Israel, and then they withhold weapons in the middle of Israel's fight for survival.
Yeah, the policy that they're trying to pursue regarding Israel-Hamas, it's like, and I use this analogy frequently, it's like the administration has 1 foot on the dock and 1 foot on the canoe, and they keep drifting further apart. And they keep parsing it and trying to thread the needle that's ever narrowing. So it was ironclad, but I'm also, yes, I condemn the October 7th attack, but I also condemn people that don't understand the Palestinians. And then it goes into, yes, we want them to destroy Hamas, but don't go into Rafah.
And that's where the terrorists
Those two things are not consistent. They're mutually exclusive, actually. You can't have it both ways. So it's an attempt, again, to parse these fine points, and yet they're ultimately contradictory. When you have 1 foot on the dock and 1 foot in the canoe, you're going to get wet.
We've got more coming up with Jeffrey Gundlach. Interesting to hear him talk economic as well as foreign policy.